Hello and welcome back to The Note. Back in London this week after 2 weeks in New York. Now that we're back on this side of the Atlantic, let's take a look at the Eurozone. The crisis has been in abeyance for more than a year, but people are still obviously concerned that the risk of some return to crisis hasn't gone away, and also that the European economy remains very, very sluggish. What are the prospects for next year? Well, according to my guest today, we should be seeing growth, but perhaps not the kind of growth that anybody will be greatly excited about. He's Goldman Sachs' chief European economist, Huw Pill. Huw, thanks for joining me once more. Let's take a look at your forecast for GDP growth to start off with. So we're suggesting that it stays at a double dip recession rather than a third dip, but that for quite a long way out there, you're predicting really quite unexciting growth. What are the main drivers behind that forecast?
Well, on the one hand, the reason we're a little bit more optimistic now about the outlook for 2014 than we were a year ago, and the fact that we do expect a recovery from the recession we've seen this year, is that the global economy is picking up,
right,
and we think that will support the euro area's external demand on the one hand. And second, the pace of fiscal adjustment, which has been very acute in the peripheral economies over the last couple of years, we think the pace of that adjustment will slow, and that will mean the drag on economic growth coming from austerity, if you like, will diminish. It'll still be there, it'll still weigh on growth, and that's one of the reasons why we think we're not expecting to see a sharp acceleration of growth. Because in essence, the need for adjustment in the periphery, in Spain and Italy, remains substantial. Those adjustments require further fiscal consolidation, further deleveraging, further restructuring of the economy, and all these types of activities will continue to weigh on confidence, weigh on spending, and keep demand and growth relatively modest.
Okay, now let's take a look at how this is going to be spread across the Eurozone. This is what we're looking at here is current account surpluses. Obviously, Spain entered the crisis with a very deep deficit. How is this going to work, given that Germany, by your own forecast, is going to continue to have a very significant current account surplus, but Spain, which has already suffered a lot of pain, is now going to move to an actually higher surplus than Germany by 2017, by your own forecast. How is this going to work?
Well, I mean, to some extent, that's a reflection of the necessary correction of imbalances within the euro area. I mean, these are looking at deficits, so the sort of flow position. I mean, Spain still has a very big external debt that slowly through time it needs to work down, and running surpluses in the end is the only way it can work down that debt.
But is there some political risk to whether Spain really is going to be able to make this kind of adjustment?
Well, I think, in our view, further adjustment in Spain is necessary. Of course, it's painful. Your point is very well taken. Spain has gone through a lot of pain, reflected in its deep recession of the last 2 years and the level of unemployment in the high 20% range. Whether Spain can continue with adjustment in the face of those types of situations, I think, is an open question. We remain, in our base case, in our forecast, we remain sort of confident that it will, not least because, we think the Spanish society remains committed to remaining within the euro area and recognizes that there were some excesses that need to be corrected, and therefore is a bit to accept a continuation of the pain now that there is some light at the end of the tunnel coming through in a return to growth, and in some evidence that the restructuring is beginning to bear fruit.
Okay, so good politicians should be able to keep it on track. Let's finally take a look at the European Central Bank. Much criticised, but Mario Draghi obviously has a lot to do with the abeyance that the crisis is in at present. What lies behind this forecast? Is it really going to be the case that Draghi is never going to be called on his promise to do whatever it takes?
Well, we think the ECB will continue to maintain a very accommodative and supportive monetary policy for growth, and that's what's reflected in these settings on interest rates. Again, in our base case, we don't think Mr. Draghi will be challenged to actually deliver on his OMT promise. Because the markets have taken quite a lot of comfort from the fact that he's standing as a backstop behind current developments. And as long as we can continue along this path of anemic growth in an environment of ongoing adjustment, I think probably Mr. Draghi is safe. The threat to him is less coming from the economic side,
Right.
but more coming from the political side. If we were to see a revival of political dynamics pointing towards euro area exit, or a move away from the adjustment policies, particularly in one of the larger peripheral countries, in Italy or Spain, I think those are the type of dynamics that could raise the threat that Mr. Draghi would have to respond to.
Okay, Huw, thank you very much indeed. I hope in about 5 minutes we've covered all the bases that need to be covered. I think the central truth here is that economically the Eurozone is on course to dig itself out of its problems. This crisis has always been and will continue to be primarily political. It's in the politics that the risks lie.